Hello and welcome to My Finance Teacher. This is the first of two videos on time value of money. Perhaps sometimes you heard people saying, time is money, come on, hurry up a little. That saying is related to our topic today, and the first thing that is going to help us is a timeline. Here is a timeline. We have basically a horizontal line, and on this line we represent time flowing from the left to the right side. On the very left, with the number 0, I denote the time today. That is the moment right now, and each of these consecutive numbers going further to the right on the timeline represent the number of periods from today. This could be number of years, so 1 represents 1 year later, 2 represents 2 years from now, and so on. Or this could be number of months, number of quarters, whatever it is. To show the connection between time and value, let's assume you invest $10,000 today. And of course, that investment is hopefully going to grow over the years. And let's just assume that the investment is going to grow at the interest rate of, let's say, 5% per year. How much money will you have in future within that investment growing? The amount after 1 year is going to be equal to the $10,000, the original investment, or the principal amount, multiplied by 1 plus the interest rate, in this case 5%. So 10,000 multiplied by 1.05. By the end of the second year, this amount is going to grow even further. And during this second year, before it actually finishes, all of this amount of the principal 10,000 and the interest is going to grow again at the rate of, let's assume, 5%. So all of this amount indicated with the green frame is shown at the end of the second year, and all of that has actually grown by 5%. So we multiply all of that green framed number by, again, 1.05.
During the third year, again, all of that amount is going to grow by 5%. And by the end of the third year, again, we see that green framed number is the same as that at the end of the second year. All of that grows by 5%, so all of that is multiplied by 1.05. And you can, of course, continue in the same fashion. Green is the amount that the investment has grown into by the end of year 3. It's multiplied by 1.05 by the end of year 4, which is altogether red. And all of that red number is multiplied by 1.05 to find the value by the end of year 5.
So this sort of interest, where interest is earned, for example, during year 4, interest is earned on all of the original principal, the 10,000, and also interest is earned on all of the previously earned interest during the first 3 years. So this type of interest, where you earn interest on the principal amount and also interest on interest, is called compound interest. That's over here at the bottom of your screen. And calculating these future amounts that your investment will likely grow into after some time is actually called compounding, and those amounts themselves are called future value. I'll denote that with FV. Now that we understand the concepts, let's derive the formula for calculating future value, and let's talk about some simple conventions, simple rules. First, talking about the sign convention. Remember that principal amount, the original amount invested of $10,000. That is going to flow out of your pocket and into the investment. A flow out of your pocket will be denoted with a negative sign. And if you cash out your investment, sell the investments, and put the money back into your pocket, you will get this $10,500 back into your pocket. Flow direction will be indicated with a sign, with a positive number indicating cash flow coming back to you. That's one of our conventions on the sign and flow direction. Another convention is on interest rates. The default understanding of the interest rates is that it's a compound annual interest rates. So if these periods are not really years, but perhaps instead months or quarters, then we'll have to be a little bit more careful with our calculations. And lastly, talking about the formula, let's have a look at this green number. the future value that you will have after 3 years is the principal amount, that's the value that you invest presently, today, and let me call it present value, multiplied by the 1 plus interest rate 3 times. And as you see, the number of times we multiply by this 1 plus the interest rate, which is the compounding factor, is the same as the number of years you'd have to wait. So we multiply the present value by 1 plus the interest rate into the power of that number of years. I'll denote that with T standing for time. This perhaps is one of 2 most important formulas in today's video. So I'm going to blow it up a little bit so I can see it very clearly. And next, let's have a look at another example where we calculate future value. And our example is you investing $3,500 today at the interest rate of 6.4%. Again, no additional information about the interest rate, so on default, I assume it's a compound annual interest rate. The question is, how much money will you have in that investment after 3 years? With any sort of problem, the calculations with the computers available to you now, the calculations are done pretty easily. The most important thing is to understand the question properly. So the first thing you want to do is to summarize what is the information that you have and what information does the question request you to calculate. In our example, we do have the present value. That's the investment that you invest today. We have the interest rate and the amount of time to wait until the value of the investment we have to calculate in the future. Hence, that implies we have to calculate the future value, for which we do have the formula. And the cool thing is that with this understanding of the problem, you don't even need the text. So I can keep everything clean and tidy with the data given to you at the top and the actual calculation of future value, which we can verify. I will first take the annual interest rate plus 1 raised into the power of 3. And after that, I will multiply that by the present value of 3,500, giving me $4,215, and let's round to the nearest cent of 93 cents. Next, let's compare this value, this calculation, with an unconventional type of interest rate, let's say a simple annual interest rate where there is no compounding. Simple annual rate means that the interest is earned only on the original principal amount invested. No interest is earned on the previously earned interest. In this case, after 3 years, the future value of the investment can be calculated as follows. In the future, the investment will still include the principal amount of 3,500 and some earnings where the interest of 6.4% is earned only on the principal amount, and that happens over 3 years. So we simply multiply that by 3, giving us 4,172, which is in this case not very much different from the future value with the compound interest rate. But when you look at a longer period of time, the difference accumulates really fast. So let's have a look at another example with a longer period of time. There is even a myth or a joke where Einstein said that compound interest is the strongest force in the universe. I'm not really sure he actually said it, but it's quite cool to have a look at this example. Let's say your friend invests for the next 15 years as he's retiring after 15 years. And let's say the amount of investment is $10,000. Let's have a look at a comparison of what that investment will grow into with simple versus compound interest rate of 10.6% per year. With the simple interest rate, I just take the original investment plus that again principal amount multiplied by the interest rate and multiplied by the number of years to wait. Copying that down brings you to $25,900 by the end of 15 years. And in case of compound interest rate, I take the original $10,000 and multiply that by 1 plus that interest rate into the power of number of years. And after 15 years, that gives you a much larger number of over $45,000. Let's actually put these numbers on a chart to make things more visual. And again, on the chart, you see that as time goes by, compounding accelerates, increasing this difference between the investment with and without compounding. That's actually an interesting segue to a suggestion to consider your investments earlier, before retirement, which would give you more years until you have to cash out your investments, implying that those investments might have a chance to grow into a more considerable number. By the way, while we are in Excel there is actually another simpler formula to calculate future value with compounding, where you don't have to type in the details of the formula by hand. But before we use that formula to calculate future value, it's always useful to review what data you have in front of you to make sure you understand the question. Present value in this case is negative $10,000, as it's a cash outflow from your pocket. The interest rate is 10.6%, and we're investing for 15 years. That's the number of time periods. To calculate future value using that simple Excel formula, simply hit equals, type FV, open the brackets, and the computer will give you the hints on what numbers go next. As you see here, it says rate, so I'm just going to click on this number. Alternatively, I could just type that number as 0.106, or 10.6% would also be understood correctly by the computer. I like to use cell references, which helps when you copy the formulas. Then you gotta hit comma to get the next hint for NPER, which means number of periods. That's the time periods. So I'm just going to click on this cell, hit comma, and we'll get PMT. That's the regular payments. As we keep things simple in this video, let's skip the payments for now. I'm going to hit the comma again, coming to the present value. Click on the present value, ignore that type, close the brackets, and hit enter, giving us the same number of over 45,000 as we get with the manually calculated formula. So there's that formula again as text, just to show the cell references again. I hope this has been helpful. In the next video, we'll have a look at calculating present value.